So with the markets in turmoil, we fortuitously have our good friend Stephane Link here with us to share her thoughts, reactions, and a little bit of her outlook for what might lie ahead. Well, Stephane, thank you for being here. The plan had initially been to have these play in a few weeks. We're going to be fast tracking that. So about a week from today is tariff day for the markets. Lots of pandemonium, at least if you listen to the television, which we just watched you on here moments ago. So yeah, wanted to get your reactions not only to today, what might lie ahead, the economy, but when a day like today happens, in general, U.S. markets down about 5%, give or take the indices. How do you feel? What are you thinking?
Well, it doesn't feel good. And by the way, thanks for having me back.
Yes.
No, it doesn't feel good. It makes me feel very, very badly because the money that I run, I view it as my own money. And it's very important to protect and to see if you don't go down as much as the market. And if you can beat the market on up years, right? It's been a challenge the last couple of years, but it doesn't feel good. It's a shock to the system because the news from the tariffs were surprising. They were much worse than most people had expected. And we all expected news, but we didn't expect it to this degree. And so my initial reaction is, okay, let's look and see what's getting hurt the most. Are there opportunities? Are there things that I can do to take advantage of these really big moves? Because today was really a lot of moves. I mean, the market was down 5%, but there were a lot of sectors that were down double digits.
Big moves.
Big moves.
Shocking things. As I was watching things, I'm like, is that a year-to-date from peak or just a today number? And there were some big things. In your comment, though, is that initial reaction. Nobody likes to see red on the screen. But then pretty quickly a pivot to where do we go when a lot of people, and maybe even a lot of people out there advising people, are running for cover or cowering. You're thinking about, what can I do in a moment like that?
Yeah, it goes back to my days working with Jim Cramer. He used to ask me every morning to set levels. What would you buy? Which stocks would you buy? At what level? If it fell 5%, 10%, 15%, I would make a list of like 3 or 4 names in a market decline. And if it got there, I would buy it. And the reason he did it is because it took the emotion out of it. Right. It's very, very hard to buy something when it's down 10%, 15% in a day. And I will say, those kind of moves tend to take a while to kind of sort themselves out. So I don't expect like a V-shape tomorrow kind of thing, or maybe even in the next month or so. But I do think that if the fundamentals haven't changed materially as to why I bought the stock to begin with, if the management of these companies, if it's a strong management team that has gotten themselves out of issues and problems before, if it's a sector that I don't think earnings are going to be materially impacted, and we could talk about some of those if you like, if all of those things kind of are in place, well, why wouldn't I want to buy it 10% cheaper?
Right.
And that was Jim's strategy of, if sometimes we would buy stocks and we would root for them to go down so you could get a better price. Your average cost it down.
I forget if it was his quote or someone else. I mean, I think he at least heard him paraphrase at some point of, stocks are the only thing that people aren't excited to buy at cheaper prices.
That's very true.
Right? The t-shirt, the shorts, the jacket, whatever you want. Oh my God, it's 50% off, but a stock, suddenly something you loved at a higher price, now you dislike at a lower price.
Totally true. And Tim, it's people say they buy low and sell high, but they don't. Right. They buy high and sell low, and that's not a recipe for winning. Your initial question is, I'm just trying to find an opportunity. I'm trying to go a little against the grain. Does that mean buy a lot of it? Right? No, it's just nibbling a little bit because no one knows, given the tariffs, what it's going to mean. Because we don't know if the tariffs are a negotiation tactic by Trump and the administration. I suspect you'll see a little bit of it, but we don't know fully what to expect from here. What we do know is if you take the numbers as a whole that we learned last night, it goes through, and there's no negotiation and no change, that would be a 1.5% hit to GDP. That would be a 1% increase to inflation, although I disagree with that a little bit, only because I think we could do things like from productivity to get that a little bit less. And it would be a 3 to 5% hit to earnings. Well, those are big numbers, but I would argue up until the tariffs, we were probably growing at about 1.5 to 2%. So you're now thinking if it goes through, maybe we're flattish, maybe we're negative. Earnings are the most important, what happens to them, because that's what stocks follow, profits on the way up and on the way down. And earnings were expected to grow 9 to 10% this year. So if you give it a 3 to 5% haircut, you're looking at 5% for the year, you're still growing. You're just not growing as fast. And so that's what the market is trying to kind of figure out. I just think by the time the market figures it out, we'll probably have bounced and we probably will have bottomed. So I want to be able to add into the volatility.
Yeah. How do you, on this pullback, I think a lot of times people, never mind the hyperbole that might be out of newspapers or the media in general, or just how they feel watching something drop 5%. But when they're hearing plummet, that they take what they see in a day in the market and extrapolate that out into the future economy. And so you're talking about, okay, 1 to 1.5%, which again could take us close to a flat line from a GDP standpoint, not necessarily maybe from a corporate earnings standpoint.
Right.
But talk a little bit about the disconnect for clients between the economy and the market. They're certainly interrelated, but they're not always the same thing. We saw that during COVID when we shut the economy down and the S&P roared off to all sorts of new highs.
Right. Well, I think that a lot of the times there is a correlation, but sometimes it's stronger than other times. I think that's really the message. And to be honest with you, the economy is okay right now. It doesn't feel okay, but as I mentioned, I think we were going to grow 1.5, 2% before the tariffs. That's a slowdown from the 3% number we have seen for the last 2 years. We were always going to slow down in 2025 because the policies are different, meaning we put a lot of fiscal stimulus in place over the last several years because of COVID, but because of the Biden administration, and that's what they wanted to do, and they wanted to continue the growth. And by the way, if they continued the growth, unfortunately, we had a little bit of an inflation issue. However, that growth this year is not going to come from the fiscal policies. This administration is different. They want to grow through more pro-business, deregulation, lower taxes. That's how they are going to grow. When you marry the two, naturally you're going to go from 3% in GDP under a fiscal driven growth versus Trump's administration. So to me, that's one of the reasons why, because you asked about the markets and the correlation, that's the reason why I think prior to tariffs, we were on the way down. We were negative. We were negative 4% in the S&P 500 before the tariffs. And that is because people were nervous about the overall growth in the economy slowing. Some people were calling for a recession. I was not in that camp. And I think it's a close call right now. I really do, in terms of, I still think we can eke out growth, because if you look at some of the metrics out there, we've seen lower interest rates. That's actually stimulative. We've seen lower gasoline prices. That's stimulative, right? We're down 11% in gasoline prices. We are seeing a little bit of green shoots in housing. We're seeing better industrial production, durable goods, and durable goods have actually beaten, and we haven't even seen Boeing produce the amount of planes that they're capable of doing. So I think there are things out there. We have manufacturing and services of our economy. They're still in solid shape. So maybe not as strong as they had been, but they are beating expectations. And so you kind of add it all up, and we were running at a 1.5 kind of level, 2% level. But the market didn't like it, right? So that's markets telling you that they were nervous that the slowdown would slow earnings, and therefore that's why the market was down.
I know we talked about it last June. We wrote about it pretty extensively in We Being 10 Capital and Q3 for early Q1, which is hey, some of the stuff is super expensive.
Yeah.
And especially if you're just buying general indices, not necessarily our approach, no, not your approach, you're really overexposed to some of the most expensive parts. And so definitely tariffs, the economic slowdown there. Some of this, though, is, man, it's been a heck of a 2 years in the US equity markets that took us to some arguably frothy levels that, to your point, whether it was the economic slowdown or even the market, probably always had to give a little bit back. And I know people struggle, they want to see that peak number stay peak, but it's just not how investing works.
Do you know that prior to yesterday and the tariffs, that 94% of the decline in the S&P 500 year to date is from the Magnificent Seven?
90 before today?
Before today.
Interesting.
Isn't that? So
Interesting.
it tells you that, because to your point, those were the frothy sector, right? Those are the frothy stocks. So I actually think that we're getting some opportunities in the Mag 7. I don't think they're dead. I don't think they're over, but they're still not cheap.
Well, I was gonna, yeah, I know. So, like, is this a super great buying opportunity? I think it's certainly a better opportunity than it was earlier. Some of those have got, near 20+ drawdowns in those names, but man, some of them had epic moves over the last few years. All right, Steph, so things are getting a little cheaper. Lots of parts of the market are actually holding up well, as you were just talking about. I think a lot of our clients have been pleasantly surprised to call in and find, our value stocks are up, our international stocks are up. But coming back to the US, in general, obviously everything's a little bit cheaper. What are some potential positive catalysts you see in the back half of the year that, again, could give people a little bit of hope, whether they're going to buy tomorrow or they're going to buy in the next couple weeks? Some reasons for hope and optimism as we move into the back half of the year.
So the reason for the tariffs, I mean, I know we've been hearing about it being a fentanyl issue. That really is more just Mexico, China, and Canada. But beyond that, which is a very big issue, of course, the reason is that the Trump administration, they want to bring companies back to the United States. We have lost industries, we have lost jobs to overseas, as many companies have left the United States to outsource elsewhere, China being one, India being another, Europe, etc. So if that in fact happens, that actually is very good for the long term, for the growth of the economy. And it should lead to more jobs. And if the tariffs work, it should all be part of the same theme, if you will. So that's a good thing. And then the second thing, the second half of the year, I think once we get through this tariff thing, they're going to start focusing lower taxes, right? Deregulation. I do think you're going to see M&A pick up substantially. That's why I think some of the financials make some sense, down double digits today, right? So I think there are places to watch. I don't think the consumer is going to fall off a cliff. I think they're scared. We're all scared. It makes sense. But they have jobs, they have wages, and they have savings. So they're in a little bit better position to handle this air pocket.
So you have some hope.
I have some hope.
All right. Well, no longer video than normal, but on a day like this with a guest like Stephanie, we wanted to give you as much great information as we could. Thank you so much.
Thank you.
So I know that's a little bit longer than our typical shoot, but on a day like today with a guest like Stephanie, we wanted to get you as much great information as we could. Stick around. We'll be shooting here momentarily. It'll be to you a week later than this, part 2, where we'll really get into investment mindsets that hopefully can help you in the months and years ahead.